Welcome to the Deep Dive. Today we're digging into Hilton Worldwide Holdings, ticker HLT, and their Q3 2025 results.
And the immediate news was pretty positive. Hilton beat expectations on both the top and bottom lines. Stock got a nice bump.
Right, a pop in pre-market. But
Mhm.
you mentioned a more complicated story. Let's start with the scorecard, the raw numbers first. They looked good on the surface.
They did. Adjusted EPS, that came in at $2.11. Analysts were looking for about $2.06, so that's a 2.43% surprise. Nice beat.
Okay, $2.11 versus $2.06. And revenue.
Revenue was also strong. $3.12 billion reported. The street expected around $3.02 billion, so that's a solid $100 million beat there, too.
So beating on both counts, which the market likes to see. But what about operational efficiency? Adjusted EBITDA is usually a good tell.
Yeah, and that was another strong point. It rose 8% compared to last year, hitting $976 million. And importantly, that actually beat the high end of their own guidance range.
Ah, so they outperformed even their own internal targets. That's just pretty tight execution, doesn't it?
Definitely. Strong cost control, good operational discipline. It explains why the stock jumped, what was it, 4.37% in pre-market?
Yeah, pushed it up near $272, which is close to its 52-week high.
Right. But here's the first sort of cautionary flag for you as an investor. Even with this strong performance, that stock price puts the PE ratio, well, it's high, 42.45.
42 times earnings, wow. That suggests the market's pricing in a lot of future growth, maybe even perfection.
Exactly. It implies the stock might be, a bit overvalued right now, despite the good quarter. You need continued stellar performance to justify that.
Did any other core metrics look particularly healthy, like franchise fees?
Yes, that was a positive. Management and franchise fees grew 5.3% year over year. That's a good sign for their core recurring revenue stream.
Okay, so a high valuation needing justification. Let's link that to the forward view. What did management actually guide for, given this performance?
Well, they did lift the guidance for the full year on profitability. The adjusted EPS range for 2025 is now $7.97 to $8.06. That's up from before.
And EBITDA?
Adjusted EBITDA also got a boost. Now expected between $3.685 billion and $3.715 billion for the full year. So confidence there on the profit side.
Good, good. But the real story in hotels often boils down to RevPAR, right? Revenue per available room. How did that look, and what's the forecast?
And that's where the picture gets, shall we say, nuanced. For the full year 2025, they actually narrowed the RevPAR guidance, now projecting flat to maybe up 1.0%.
Flat to 1%. That's not exactly gangbusters growth, is it?
No, it's not, and it reflects what actually happened in Q3. System-wide RevPAR decreased by 1.1% compared to last year.
Wait, decreased. So they beat earnings estimates, but the core metric of hotel performance went slightly backwards.
Precisely. It really highlights how much that cost control and efficiency drove the earnings beat. The underlying room revenue wasn't quite there.
So what's the outlook for Q4 specifically? Are they expecting a rebound?
A slight one. We're forecasting RevPAR to increase about 1.0% in Q4 compared to Q4 2024. They mentioned holiday shifts, easier comparisons, and maybe some relative strength in group bookings helping that.
Just a 1% bump expected,
Right.
and Q4 profit guidance.
Adjusted EPS for Q4 is expected between $1.94 and $2.03. Adjusted EBITDA between $906 million or $936 million. So modest improvement expected there, too.
Okay, banking on small steps forward. Let's go back to that Q3 RevPAR decline. What drove the weakness, especially in the U.S.?
Yeah, the U.S. was the main drag. U.S. RevPAR was down 2.3% year over year in Q3.
Ouch. Why?
Management pointed to a few things. Softer business transient demand, some group travel didn't materialize as expected, holiday timing, and maybe less international inbound travel than hoped for.
So the core business traveler, the convention segment, still a bit soft domestically.
Seems that way. The middle of the market felt the pressure.
But Hilton's global,
Right.
right? Did other regions pick up the slack?
They absolutely did. The Middle East and Africa saw RevPAR jump 9.9%. That's huge.
Wow.
And the Americas, but excluding the U.S., was up 4.3%. So yes, strong performance internationally helped offset that U.S. weakness. China was also mentioned as being a bit soft, similar reasons to the U.S.
Interesting regional divergence. And the other big factor is probably luxury, isn't it? Affluent travelers seem less bothered by economic jitters.
That's been the consistent story, and it held true in Q3. High-end demand is very resilient. You look at their luxury brands. LXR Hotels and Resorts RevPAR was up 6.4%.
6.4%?
Conrad was up 2.6%, and Waldorf Astoria up 1.7%. So the luxury tier is definitely providing a buffer, masking some of that weakness elsewhere.
Right, a clear split. Premium leisure strong, mid-market business group weaker. Okay, so if near-term RevPAR is sluggish, that high PE must be betting heavily on future growth. Where's that coming from?
The pipeline.
Exactly. The development pipeline is the engine. It's frankly enormous. They added almost 25,000 rooms in Q3 alone.
25,000 rooms in one quarter.
Yeah, hitting 6.5% net unit growth, or NUG, for the quarter.
Net unit growth, so openings minus closures,
Yep.
and the total pipeline.
Record levels.
Wow.
515,400 rooms in development. That's up 5% from last year, and nearly half of those are already under construction.
That is a massive backlog. What are they guiding for NU long term? They expect 6.5% to 7.0% NUG for the full year 2025. And they're aiming to sustain 6.0% to 7.0% annually over the next few years. It's aggressive expansion.
And a big part of that is conversions, right? Taking existing hotels and rebranding them.
Precisely. It's faster and cheaper than building new. They just launched their 25th brand in October, Outset Collection by Hilton.
Outset Collection, what's the focus there?
It's a lifestyle brand targeting conversions in that upper mid-scale to upscale space. Think existing independent hotels.
How big is that market?
Huge. Hilton estimates that segment unbranded hotels is over half the global hotel supply. So this is like a strategic land grab for existing properties.
Makes sense. Are they getting traction with Outset already?
Apparently so. They mentioned over 60 hotels already in development just for Outset in North America. Long-term potential, they think, is over 500 hotels for that brand alone.
Wow, and conversions generally are key.
Critically important. They expect almost 40% of all their openings in 2025 will be conversions, spread across 12 different brands. It's a core part of hitting those NUG targets.
And they're not just relying on conversions. They're pushing existing brands into new territories, too.
Definitely. Big push in Asia-Pacific plans to get over 250 luxury and lifestyle hotels there, which is like a 50% increase in that portfolio for the region.
50% growth in APAC luxury lifestyle.
And think about this. Hilton's in 141 countries, but on average, they only have 4 of their 25 brands operating in each country.
So much room just to bring existing brands into markets where they already have a presence.
Immense runway for growth. They debut brands in 12 new countries or territories just in Q3. DoubleTree in Pakistan, Motto in Hong Kong. The list goes on.
Okay, development pipeline is clearly the long-term story. Let's talk management sentiment. CEO Chris Nassetta sounds very bullish, almost dismissing the near-term RevPAR softness. What's driving his optimism?
He's looking further out, betting heavily on a U.S. macro recovery. He actually said, I would bet a lot of money that 2026 is going to be better than 2025, and I bet a lot of money 2027 is going to be better than 2026.
Strong words. What makes him so sure? That sounds like it depends on things outside Hilton's control.
It absolutely does. He's banking on lower interest rates eventually, maybe a friendlier regulatory environment, tax certainty. But the big ones he cited were federal spending programs.
Ah, the infrastructure bill and the GPS Act.
Exactly. The $1.6 trillion infrastructure bill, he noted less than 20% of that money has actually been deployed yet. And the $800 billion GEGS Act, less than 5% deployed.
So his bet is, when that federal money finally starts flowing into projects across the country, it will generate a huge wave of business travel engineers, construction crews, consultants.
All needing hotel rooms, directly boosting that currently soft domestic RevPAR. That's the thesis. Plus, maybe some event-driven lifts in 2026, like the World Cup and midterm elections.
It's a very specific long-term bet on government spending cycles catching up. How are they preparing internally, technologically, for this anticipated boom?
Well, they position themselves as tech leaders in hospitality. 90% of their enterprise systems are in the cloud. And they're actively using AI, mentioned 41 specific AI use cases they're working on.
41. Across what areas?
3 main buckets. First, efficiency, using AI to streamline internal processes, cut G&A costs. Second, go-to-market, things like optimizing distribution, maybe partnering with LLMs. And third, customer experience, or CX, using AI for mass personalization, better service recovery.
That tech focus probably helps with owner relations, too. I saw something about a new fee program.
Yeah, quite interesting. They called it a first-of-its-kind program. They're offering system fee reductions to hotel owners, but here's the catch. It's tied directly to the hotel's customer satisfaction scores.
Oh, so owners get a fee break if they deliver high quality and service.
Exactly. It's a way to share some of the efficiency gains Hilton gets from scale and tech, but also to incentivize owners to reinvest in their properties, especially now when costs are high and RevPAR is flat. Keep the standards up.
Smart way to align incentives. Okay, one last piece. What about returning cash to shareholders?
Still a major priority. They expect to return about $3.3 billion to shareholders for the full year 2025. That's through buybacks and dividends, significant capital return.
Okay, so wrapping up the deep dive on Hilton's Q3, there's this real tension, isn't there? Operationally efficient, huge development pipeline, smart brand strategy like Outset.
But facing flat or even negative RevPA growth right now, especially in the crucial U.S. market. And that stock valuation, that 42 PE, is already baking in enormous success down the road.
Which brings us to the final thought for you, the listener.
Right. The CEO's very strong optimism for 2026, 2027, it hinges almost entirely on these massive, slow-moving government spending initiatives, infrastructure, TGPS Act finally kicking in and boosting business travel. Given the current RevPAR softness and that high valuation, how much faith do you place in those macro tailwinds materializing soon enough to justify the current price? It's a big bet on future government execution driving Hilton's next leg of growth.
A critical question to ponder. That's all for this deep dive. Join us next time.